And welcome to the Nothing Show. So, in today's episode, we're going to be talking about the state of the United States economy. We're going to be talking about money and how our economy and how the world economy works and the health of all the current system that we have in place. This all got inspired. I was talking to my buddy the other night, and he's been watching this guy, Chris Hedges, who's kind of a doom and gloom guy. Says, the United States is just going to go into a shit box, and then we're all going to be taken over by the Chinese and Brazilians and the Russians and everyone else. And so, and the reason this is important is because we were discussing personal finance and where and how we thought we should, personally invest our monies. And so I was kind of walking them through like my thoughts, like the basics. First of all is, there's certain levels of risk involved with each type of investment. So my primary investment is what I call the shoebox. I keep it under my bed. You don't need to know about the shoebox investment. Is it safe? Well, someone could come into my house and rob me and take my shoebox investment. So maybe not the safest place to keep your money, but it's not going to get hacked. It's not going to get, I'm not going to lose it because a stock crashed or a company failed. Again, I could take it to the bank and put in a savings account. You're not going to make any interest. And we're going to talk about why this isn't really a good investment because it's devaluing at the rate of inflation. And even we're going to talk about the manipulation of the rate of inflation. So that could even be worse than the 2 or 3% the government likes to tell you. And so, and again, because the dollar deflates, you could take all your money and put in a safe deposit box, I suppose, at the bank. And if the money didn't devalue, you come back in 20 years and it'd be okay. It'd be a good investment. But with the rate of inflation, it's just, to me, this is not financial advice, by the way. This is just my personal opinions. This whole piece is just my personal opinions. Don't take any of this as fact. The whole show is my personal opinions. Nothing here should be taken as facts. But this is just what I was thinking. Okay, so back to it. So, yeah, I keep some money in a savings account, because you want to be able to pay your bills easily and those kinds of things. And then what's the next one? The next one is bonds. We're going to talk about bonds today. And again, because the interest rate has gone to zero, you're really not making much money on bonds. And bonds to me, are part of a Ponzi scheme that I'm going to explain later in this episode. So I don't own any bonds that I'm aware of. So the next, and we're talking about like risk assessment, again, at least if you're in a savings account or in a bond, you're not going to lose your investment in a fire. A bond is like borrowing money to the United States government, and that's considered risk-free. So bonds are good in that sense that you're not going to lose your money unless the United States government loses its money, which means the whole world loses its money, which I'm going to explain in just a minute. So stick with me here. Follow this money trail here. Next, investments would be like index funds and mutual funds. You do have an exposure to risk. Typically, a good index fund, again, this is my opinion and not a financial advice, should be making 8 to 10%, which should at least get you over the hurdle, which we call usually like a 7% mark. That, accounts for inflation and CPI and other things that, we can talk about it probably in a later date. But if you're making 7-8% on your money, at least it's not devaluing. You're not losing value just by holding your money. Your exposure to risk, there is some. These are typically Vanguard funds. And again, over time, they perform at like an 8 to 10% return. But there is some risk, if the United States economy collapses and your Vanguard fund is in the top 500 companies in the country and they implode, like we saw in 2008, you're going to lose some money. So there is some risk, but over time they've performed very well. Again, not financial advice, but with programs like the Roth IRA, uh, mutual fund, I think for again, I do it. I do my 5,000 or 6,000 a year um, in a couple different Vanguard mutual funds, and then again, your earnings on this on your Roth IRAs are tax free. Your capital gains because you're putting in the money post after it's been taxed. So after you get your paycheck, you contribute to the fund, and then when you get to 59 years old, you can start taking it out tax free on your capital gains. So I think it's a great program, not financial advice, but again, a good starting block because again, well, we just talked about, you got a very low risk of losing all your money, and you got a decent return. And again, if you're young and you start this when you're 25, and you look at the curve, it's great. When you get to be like 40 or 50 years old, when you've been contributing to it for 25 years and you get what's called compounding interest, the curve goes up really dramatically right at the end before you decide, before you hit the normal retirement age. And you can have millions. You don't need crypto. You don't need any of this. You just put a little bit aside for your whole life and you'll be just fine. But again, this is more, this gets bigger than just saving your money. That's just, again, one aspect of what we're trying to do here is um, save some money. So again, mutual funds, lower risk, and at least what I would consider an acceptable return. Um, with anything below the 7%, I feel like you're just getting bled slowly. What's the point? So the next would be stocks. When you invest into an individual company, I'm not going to get into market caps. Again, with companies with large market cap, what we call blue chip stocks, you're going to have some exposure to risk, but these are companies like Amazon, Microsoft, Facebook, Tesla, the biggest companies in the world. Apple, they've been around, they're going to probably be around. So your exposure to risk is, again, somewhat, but not keep you up at night risk, right? So again, and diversity is so key to everything. Diversifying in your crypto, diversifying in your overall portfolio. I believe you should have some mutual funds, you should have some stocks, you should have some crypto, you have some real estate. You have a little bit of everything. That way, if something craps on you, you got backup. And from the people that I talked to that managed the 2008 crash well, they were well diversified. And it didn't really, yeah, they lost a bit, but it didn't, they weren't devastated, crushed. They didn't have to sell the house. So diversification also lowers your risk to exposure to losing all your money. There is a point where you can be too over diversified, where it's just too much going on. You can't watch everything, that closely. So there is a balance there. So anyways, we're talking about stocks. So stocks, yeah, you're investing in the performance of an individual company, whereas a mutual fund or an index fund, you're investing in like the overall performance of a group of companies or a group of products. So yeah, stocks kind of, in the middle there, maybe more on the riskier end of investments. And again, real estate's another very good avenue for investing. It's just I'm not a real estate investment expert, but I know buying mud over time is, again, a great investment. I just don't own any mud, so I have no room to really speak on it. Not that I have room to speak on what I'm speaking on, but I'm doing it anyway. So moving on. So stocks, kind of a higher risk investment. And then the most highest risk, the most speculative market out there, the place where you can really just lose everything, is crypto. But again, because of the high risk comes the high reward. That you don't talk about 5x and 10x and 20x and 100x in stocks. It just doesn't really happen. I mean, you saw 5x with the GameStop and AMC, and people were like out of their minds over it, right? So, but we see 5x and 10x in crypto all the time. There's a lot of volatility, highly speculative, not for anyone that just, if you just want to, like make a contribution to a fund and not have to think about where your money's going and have someone else manage that for you, that's great. That's what, most people should do. But if you're someone that likes to, do the research and get involved and be in control of your own destiny and your own money, and that's then maybe it's something you consider. But for me, I like it. It's exciting. It's fun. Again, I'm using responsible leverage when I trade. I'm only putting money into crypto that I can afford to lose. And then I also contribute regularly to my Roth IRA so that I have some diversification. So when crypto craps on me, I won't be totally out of luck at trying to get into the ground when I die. So anyways, we're talking about, so you got to decide, are you going to put your money into a shoebox or are you going to invest it? And so anyways, me and my buddy are talking about, is the United States doomed? Are we are we just on this spiral to the bottom of the rabbit hole? And to understand the problem, you got to understand the United States dollar. And again, this all can tie back into blockchain and crypto. But let's just start at the beginning, which starts, I believe, at the end of World War II, 1944, in Brentwood, New Hampshire. The United States dollar was established as the world reserve currencies. And they did that because at the time, the United States dollar was tied to the price of gold. Now, gold is just kind of hard to, pay your bills with and transport. It's heavy. You can't just, take a piece of it off and pay somebody with it. So the United States dollar is convenient paper money, and it's tied to the price of gold. So it's therefore as good as gold. So in 1944, after World War II, we established the United States dollar as the world reserve currency because it was tied directly to the price of gold. And from that, all the world's other currencies were tied to the United States dollar because it was tied to the price of gold. And then in 1971, because we had been fighting a war and spending billions of dollars on it, and we were printing more money than, this is speculation, by the way, than we had gold, and our foreign trade partners got suspicious of this and said, you know what, send us the gold. We don't want your dollars. We want the gold that it's supposed to represent. And so you had all this speculation on whether the United States had enough gold to cover their United States dollars. And Nixon said, well, we're going to just suspend the gold standard. And that happened on August 15th, 1971. It's kind of a famous day, or infamous, right? From that point on, what we had at one point was called money because it had a store of value because it was tied to gold, became a fiat currency. And what's a fiat currency? It's a currency that has no real intrinsic value, that because of the political push, because the government says it has value, and because we all agree, have confidence in it, that it does have value, that's how the value is established. So since 1971, we've been off the gold standard, and we've been on now fiat currency. And since almost every other currency of the world was, again, tied to the United States dollar because it was tied to gold, they are all now fiat currencies also. So the United States dollar dominates world trade. You look at oil, you look at coffee, you look at gold. It's all traded in United States dollars. there's a lot of reasons for this. We can't get into them all, but one is that United States dollar is very liquid. You can get your dollars anywhere. Um, but because of this, because of so much of the global economy is done in United States dollars, it gives the United States government control over their own currency. So we can deny access to our currency to our adversaries that don't want to play ball with us, such as Cuba and North Korea, Iran to some degree. The Europeans are always trying to skirt around us, but story for a different day. So anyway, because the global economy is tied to the United States dollar, we can kind of manipulate other countries to do our bidding. So we just started printing money since 1971. Since we went off the gold standard, we always have ran at a deficit, regardless if it's good times or bad times. We're just printing money, and then I want to explain how the United States dollar is a Ponzi scheme. And if you're not familiar with a Ponzi scheme or a pyramid scheme, basically, it's like the new investors pay the old investors, and up the pyramid. And when everyone pulls their money out, the pyramid collapses. Now, after we went off the gold standard, the United States can basically borrow and spend as much money as they want. So when the United States government needs some money, they take a loan from the Federal Reserve. Now, the Federal Reserve has a government sounding name, but it's actually a collection of private banks. And I don't even think you know who the banks are. I don't know if you get to know who all the individuals are, but it's a private bank. Okay. They just have a government sounding name. So United States borrows money from the Federal Reserve, and they give them an IOU. The IOU is called a government bond or a bond, right? And so United States government needs some money. They borrow it from the Federal Reserve. They give the Federal Reserve bonds as a IOU. And then the feds and the Treasury work together to sell these bonds to foreign nations and individuals. And again, loaning money to the United States government is what you're doing when you buy a bond, is like a risk-free investment, right? And this is like the beginning of the Ponzi scheme, right? Because the feds can just print money out of nothing, and then loan it out to the United States, which creates a liability. And of course, we always borrow the money at an interest rate. And so to pay back the loan, we always have to borrow more. Imagine if there was just $1 in existence, and we borrowed that dollar, and we promised to pay it back with another dollar. Now, to pay it back with another dollar, we gotta borrow another dollar, because there's not another dollar to be had. So they print another dollar for me to borrow. Now I borrow that dollar to pay back the original dollar, but now I owe you again the interest. So it's a perpetual cycle that always requires me to borrow more. So this is what and this is how it affects trade. We have a trade deficit. We've been running a trade deficit forever, right? Our Walmarts are filled with Chinese goods, and we buy most of our oil from the Middle East and Japan and Korea. Make us tech and cars, and so we have this deficit. You guys want to meet my dog? Where's my dog? There he is. That's Archer. You good boy? Yeah, he's a good boy. All right. Okay, so we run a trade deficit, right? We buy all these goods and stuff from all these other countries. And now if those countries took their profits from trading with the United States and put it back into their own currency, then the value of their currency would go up. If their currency goes up, then they become a less desirable trading partner. So countries have no interest in putting their profits they make off of us back into their own currency because it raises the value of their own currency, and now we can't do cheap manufacturing. So to keep their own currencies devalued, they buy United States bonds with their profits. And now, if you're following the money, the United States borrowed some money, created a bond, sold the bond to these foreign nations to begin with. And then when these foreign nations make profits off of us, they have to turn around and put the money back into the bonds. Otherwise, they're going to inflate their own currency. And now you got your Ponzi scheme. Do you see? It just flows in a circle where there's a continuous cycle of always having to borrow more to keep the cycle going. And that's why when we go back to this argument that the United States is all gloom and doom, and we may be. I'm not here to say that we're not, but if we are, all of our trading partners, which is like, most of the developed nations in the world, are also going to suffer. Because as soon as everyone pulls out, like if you had a run at the banks, if everyone was like, give me my cash, we'd have a serious issue. And it wouldn't just be the United States. It would be the whole world, right? So who's interested in seeing the whole world economy collapse? Probably not very many people. Maybe China, maybe then anyone that's, any kind of nefarious bad actor that wanted to step in that void, there'd be that opportunity, right? So that's one side of it that I don't see it ever totally ending that way because the whole world would collapse around on it. But let's look at some other things too, starting back in 1944 and what's happened to this country. When my grandpa was starting his family or raising his family, I think he was a truck driver and had 4 kids. Well, had 5, total, but one died. One of my aunts, I think, died before most of my aunts and uncles I only have aunts on that side. Sorry, before my other 3 aunts were born. Maybe my oldest aunt may have been alive. I don't even know I don't know. It was a long time ago. But she was like tragically killed, screwing around behind a car, playing hide and seek. I digress. But anyways, my grandpa just had a blue collar job. I think he was, like I said, a truck driver, but he was able to own his own home and support a family of 6, Who could do that now? Who could have just one job and support a family of 6? That's impossible. So what happened so we were on the gold standard, and then again, you saw us go off the gold standard in 1971. And then what happened? Well, I wasn't born until 1974, but my mom got a job, as did a lot of our moms, right? In the middle class. We had to maintain our, our living conditions, our, what do you call that? Our quality of life. So to maintain our quality of life, mom had to get a part-time job. By 1990, the savings rate was like 0. Like overall, people were not saving money and prior to 1990, people did. People had money in savings account. And then you look at it like today, right? That both parents are at work. I think in my own community, I heard a stat that said that 60% of Tucson could not pay an emergency $500 bill. So we've had to borrow, right? Everyone's in debt, and a lot of people are so in debt that, it's impossible to ever even get out of. So and that's because of the devaluation of the dollar, because they just keep printing more and more money, right? And when you print, you keep printing more money, the money becomes devalued. Now, the government will tell you that it's 2 to 3%, and the banks will tell you that is it's robust. We call that the co-inflation, which doesn't really matter. But what really matters is what's called headline inflation, which is when you take in consideration like energy costs and tax tax rates and things like that. So your money is deflating. So the government tells you it's between 2 and 3% because they're paying out Social Security based on inflationary numbers on their own inflationary numbers. So they have no interest in telling you, are even using like the headline inflationary number, because then they have to pay out more, and they're trying to control a debt, an ongoing debt, right? So in order for me, in my mind, to at least keep my money from becoming, from losing money, you got to make it over that 7% hurdle, because that's, like, in my mind, again, opinion piece, where we're at. I know this is all kind of dry and boring, but you got to understand that we're facing probably some real economic uncertainty, because we have a system of fiat currency that can't. And again, I guess you could argue that could just continue going on, and we just keep borrowing and borrowing and borrowing and borrowing and borrowing. But again, it doesn't make sense. It doesn't compute to me. I think we need a change. And I think when that change comes, it will, if you're not ready for it, it's going to really hurt a lot of people. So we're trying to get ahead of the curve here. I know it's really dry information. It's not super exciting to talk about currencies and how our money is created out of nothing and then loaned out. But it's important, because these things are going to affect our lives. It affects you when you go to the grocery store. It affects you when you go and fill up your tank. It affects you when you buy a home. It affects every, financial aspect of your life. When you go to work and spend, half your life at a job, and you come home after 30 or 40 years and you got nothing, that shit ain't right. So, we got to be aware, and we got to get ahead of the curve here a little bit, so that, we can have something, and our kids can have something, and they don't have to necessarily inherit this disastrous fiat currency. Till next time, peace.